Hey everyone, Bryan Baylon here, your local Phoenix Realtor. If this is your first time in my channel, or if you're coming back and you haven't subscribed yet, please hit the subscribe button below so that you can get updates on what's going on in the local Phoenix market. So today's topic is going to be about credit repair and your credit score and the importance of your credit score in applying for a mortgage. So a lot of people I talk to that are looking to buy a house, one of the concerns they have is their credit, and they already know. You might have already looked into what your credit score is, or you just keep track of that stuff, which is great, but your credit score is not eligible for a home, or a loan. And so how do you know? So FHA loans are basically loans that are designed for first-time home buyers. At the time, years ago, and I'm talking like 15, 20 years ago, I used to have to put 20% down on a home. Now, conventional loans can do as low as 5%, 3%. But if FHA has a lower credit score minimum as well. So if you do FHA, it's a 580 credit score minimum and a 620 credit score minimum on a conventional loan. The advantage of a conventional loan is that private mortgage insurance, which basically means if you have less than 20% equity in a home, then you have private mortgage insurance, which costs money to you, $75 to $100 a month, in addition to your mortgage payment. So in FHA loans, that PMI will be there for the life of the loan. For conventional loans, it'll drop off after you hit a certain amount of equity, usually 20% equity. Sometimes first-time home buyers, they have that just about to qualify credit score, so they go for the FHA, which is fine, and you can refinance later. Just know that it will cost, in refinancing costs, to restructure, basically get a new loan and originate a new loan so you have better terms. PMI can drop off, maybe even a better interest rate. So at that time, later down the road, you're going to want to check out if that's advantageous for you. So in terms of right now, it's May 2020. There are some tighter stipulations just due to what's going on with the markets. Right now, there's stay-at-home orders and things like that. So FHA now is doing 620 and above, and even higher in some cases. And then it's around a 640 for conventional and higher in some cases. So it is a little bit tighter right now to get a loan, but it's not impossible, right? So. But what happens if you fall under that? What happens if you fall under the minimums, depending on what time of season? If the stay-at-home order stuff is behind us, then it could be a different time. Then, well, how would you get your credit back to being eligible? So, common reasons why the credit score is low. One is because of delinquents or late payments. So if you have a late payment, it's 30 days and then 90 days. If you have a 30-day or 90-day late payment, it hits your credit score pretty significantly. It could be as like 20 points to 60 points or more on your credit score. So that's a big difference, right? That's a difference between not qualifying and qualifying, and even breaching from a different eligibility of interest rate, right? 60 points is a pretty big swing. So one delinquent, what can really affect your score. What lenders like to see is 12 months of free delinquents. So none, no late payments, no missed payments, that kind of stuff. If you miss a payment though, if you miss a payment a few days, that's fine, right? Just pay it because they don't, credit card companies typically don't report until after 30 days, after 90 days. Just get current on that, and you can negotiate with your bank to get the late fees or any interest charges waived. So depending on the relationship you have with your bank and your history of making payments on time. So delinquents is one. Two, another reason is if you have anything in collections. Collections is a big problem as well, as that will definitely hit your credit score in a way that same like late payment, 20 to 60 plus, sometimes even 100 points difference. So sometimes it's a difference of someone being in the 500s to the 600s. So what you want to do with that is if you have time, so let's say you're 6 months out or more. Right? 6 months is pretty ideal, right? This is the early stage of you looking into buying a house. If you pay your collections off, that will significantly help your case in the long term, mid to long term. So up front, what happens? Let's say you have, so 6 months in collections. They've been trying to reach you. Finally, you decide you want to buy a house, and now you'd like to pay that off. You contact them. Since it has aged a certain amount of time, that collections has aged on your credit report, it has affected your credit report, but it's sort of an older effect, right? It's an older claim against your credit. Now, if you pay it, what happens is it brings back that collections back up to sort of a fresh pull in a sense. It's just how it works, right? It's kind of strange. You pay it off, it actually dings your score again, but it repairs over time. So once that's off and they see that it consistently stays off, that's when your credit score will start to jump. So also, you don't have to pay, well, I don't want to, it depends on your collections company, but if you are in a situation where you are in collections, try to negotiate with them. You try to do 70% of the balance, 50% of the balance, and you can perhaps settle with them. And if you pay it all up front at that time. So definitely some options there, and you can try and negotiate with them. I do understand sometimes it's hard to negotiate with them. I do have clients that are working through that, and the collections companies want what they want, and so it makes it hard. So they're not necessarily able to work, but it's worth a shot, right? Then the rest from there is basically just keeping your financial history as smooth as possible. So if you have credit cards, car payments, of course, paid on time and in full, and your credit cards are 30% balance or less, and you are not having any late payments or anything like that, and then you are, even if you have to pay the minimum balance, right? And then, and you're just keeping current on those credit cards and building that history. If you don't have a credit card, right, if you don't have credit, sometimes that's the case. I come across people that don't have credit. Go to your bank and or go to a local bank if you don't bank with anyone, and request a secured credit card. So what that does is you put money into a card, right? Say $200 or so, and that's your credit, if you will. It counts towards building your credit score, but it's secured because you have funds in it. So it helps you it helps you because you build credit. A bank will feel that's safe because you've put the money, the equity in there, so that it's a safe investment. You're spending money that's already there, that's yours. So, and that'll help you build your credit as well. Anything like car payments as well, but it needs time, right? So if you're fresh in credit, it's going to take at least 6 months to a year. So there are possibly out there credit builders that can do it shorter. If so, feel free to check that out. I can't vouch for them at all, but definitely an option for you there. So hope that helps you guys. If you have any questions, contact me. My contact information is below. And hope this video has been helpful, and we'll catch you next time.